Hi, Ben.
Hi, Al.
We are now 5 years after the Paris Agreement, or COP21 as it's known. Has the world woken up to the threat of climate change?
Yeah, it's a good question. I think I sort of vacillate between some sense of anxiety. When we think about global emissions, they've risen 4 out of the last 5 years. We need deep decarbonisation to get us in alignment with the Paris Agreement. But certainly the last 12 months have given us cause for cautious optimism about the future.
I sense you might be making reference there to some of the global commitments that were made last year around achieving net zero.
Yeah, absolutely. So we have seen real positive developments over the course of the last 12 months. We've seen the election of a Biden administration that is putting climate change at the center of its policy, both domestically and internationally. We've seen the EU ratchet up its emissions reduction targets to 55% relative to 1990. And to some extent, we've seen surprise announcements from China with a net zero 2060 target, swiftly followed by Japan and South Korea with net zero by 2050 targets.
That's really interesting and quite reassuring, isn't it? I think maybe taking it away from government level, can you give us some examples of individual investments where you've engaged and indeed had an impact around addressing the threat of climate change?
Yeah, absolutely. I mean, I think that the policy framework and the international framework is clearly shifting, as you note. But we've also seen a significant increase in the adoption of things like science-based targets from companies themselves. In fact, over the course of 2020, we've seen a doubling in the pace of companies setting targets aligned with the Paris Agreement relative to the 5 preceding years. So this is now a trend that is happening across companies, and it's beyond just the sort of conventional oil and gas sectors that are reducing their emissions. We've seen financial institutions, companies involved in the agriculture and food value chains, and industry participants setting more demonstrably aligned emissions reduction targets. I think the sort of tone has changed over the last 12 months, in fact. Previously, it was often seen as detrimental to shareholders to embark upon more radical emissions reduction strategies. So there was a perception that this was going to impact free cash flows for companies. But I think over the last 12 months, we've seen a real appreciation as to the economic rationale of these deep decarbonisation pathways and how important it is to a variety of stakeholders.
Is it fair to say at a portfolio level that if all integrated oil and gas businesses have been sold, everything has been done to address climate change?
Yeah, I mean, if only it was so easy. I mean, certainly our belief at Saracen and Partners is that one has to take a sort of holistic view of climate change risks and opportunities into portfolios. And so it's not just about divesting from oil and gas firms and then saying you've done everything. I mean, I think the first point is that investors and stakeholders can play a powerful role in changing the capital allocation frameworks of oil and gas companies. So there is we definitely progress that we've seen at companies like Shell, BP and Repsol, materially started to shift their capital allocation away from fossil fuel extraction. Some of that has been catalyzed by the investment community. So I think the investment community has a powerful engagement voice. But what I would say is, if capital is still assessed to be at risk from climate change in these firms, then it's clearly the responsibility to divest there. But that really takes us into the sort of the next leg of climate risk and opportunity, which is to say that whether it's a transition risk or an adaptation risk, one needs to think much more holistically about the nature of those risks and recognize that those risks can take place in some of those industries that we mentioned before. Financial firms can have climate risk. Industry companies can have climate risk. So one really needs to think about how deep decarbonisation pathways affect all parts of the economy.
I know a number of those organisations that are joining us today are quite keen to make statements their portfolios are fossil free. Are there any words of caution that you'd recommend or put their way?
I think we have to think about it in two parts, and the first part is the extraction part. In most instances, removing oil and gas firms from portfolios will remove the significant majority of extraction of fossil fuels, but there may still be some residual extraction within metals and mining companies or indeed some electric utility firms. But then we have to think about the second part of the equation, which is fossil fuels associated with the generation of electricity, and that is a lot more commonplace. So there we can have to think about, as investors, ascertaining comfort that these electric utility firms are on pathways that are aligned with the Paris Agreement.
That's great. Thanks, Ben. So what does impact mean for you? And particularly as a climate analyst, do you think you have the ability to have positive influence around environmental issues with portfolio managers?
Yeah, absolutely. Again, sort of two principal, I think, vectors of impact for us at Saracen and Partners. And the first is really the power of engagement, and whether that's in the policy or firm-specific sphere. It is incredibly satisfying to see firms and industries sort of target these more robust emissions reduction strategies, whether that's through the adoption of net zero targets, science-based targets, or Paris-aligned accounts. The second impact is really to demonstrate the power of this holistic view of climate change risk and opportunity for clients and for returns. In the last 12 months, I think we've really seen the power of this holistic view of risk and opportunity, and the tangible impact that can have on returns for clients. But what I would say is, I still think that we're in the early days of this movement. When we think about the trillions of dollars, something in excess of $2.5 trillion a year still has to be spent to address mitigation and adaptation. And it's definitely our view that capital markets in some sectors are not adequately pricing the scale and scope of some of these changes.
Yeah, it really is a huge scale of investment up and coming. I'm always amazed that it's 5 years since the Paris Agreement was signed. What have you learned over those last 5 years in relation to engaging with companies and the measurement of impact, and the lessons to be used in the next 5 years, for example?
Yeah, I think probably two elements strike me. The first is the power of having sort of tangible requests when approaching firms. We can often talk about the Oxford Martin School principles or net zero targets, science-based targets, integration of Paris alignment into financial statements. I think those sort of tangible requests are powerful rather than sort of somewhat ethereal climate risk integration. It's also, interesting and quite remarkable how quickly it is changing now to see net zero aspirations be seen as sort of a base level request, whereas once they was perceived as somewhat extreme. And then the second sort of lesson, I think, is these messages are often best received when conveyed in the terminology of sort of tangible risks and returns for companies. And that has definitely shifted. A few years ago, it was perceived that, taking up more robust emissions reduction targets would be negative free cash flow for the company and detrimental to shareholders. But I think over the course of the last 12, 24 months, many industries have shifted. The economic and strategic rationale of deep decarbonisation is now a powerful one.
I find that personally very reassuring, and thanks very much for your time. Hopefully there's plenty for people to think about.
Pleasure. Thanks, Al.